when to sell your stock portfolio. Hello lovely YouTube family, welcome back to our channel. In today's video, we're going to talk about when to sell your stock portfolio. We will look at what it entails in general. Without taking more time, let's get right into it. Stock portfolio. It is a collection of equities in which you invest with the intention of profiting. You may become a more robust investor by assembling a varied portfolio that spans several sectors, because if one area suffers a setback, your investments in other industries aren't necessarily impacted. It's critical to have your objectives in mind before putting together a stock portfolio. As a result, logic rather than emotion will govern your decision making. Some people invest in companies they really like and sometimes even hold on to stocks when they know it's best to sell. The sunk cost fallacy is a term used to describe the second option. This misconception refers to clinging on to investments or initiatives for longer than necessary because you believe you've invested too much to back out. Number 10, when you need to rebalance your portfolio. This simply means not putting all your eggs in one basket. With investing, you'll always be risk exposed. However, the best way to cushion yourself is by having a well-balanced portfolio. The best way to diversify your portfolio is by investing in different industries, different types of investment funds, and other commodities. This is how to spread risk. If something was to go wrong, and chances are at some point they do, you'll be covered. Number 9, when you need actual cash. As much as investing in stocks yields your capital, sometimes one may need money for an emergency. Even though the market could be performing well, you may still be required to sell. Stocks are actually assets that are set aside for times like these. Being able to convert your stocks to cash to facilitate your financial issues is much easier than running around in financial institutions or families asking for help. This may be so difficult emotionally because building up over the years just to sell them off isn't the best feeling. What could help in such a situation is to try and remember why you invested in the first place. I'm pretty sure your main aim was to create wealth. Selling doesn't mean everything is in vain. Additionally, it allows you to pick other stocks that have the potential to grow. Number 8, when valuation is higher. What exactly does valuation mean? In this case, it means how much one believes a company's future cash flows will be worth. Investors frequently prefer to sell their stocks when a company's valuation exceeds that of its competitors. No one can accurately predict the future, and so a small room for error is excused during appraisal. Selling stock for valuation is a more complex approach, but the rewards can be substantial once you've mastered it. Number 7, when there's a rise in stock price. If you're holding a stock whose price is shooting dramatically, you have to sell. Excitement might get in the way, but you need to be rational in your thinking to ensure you don't mess up your hard-earned money. Once you bag your earnings, move on to the next opportunity. Allowing emotions to get the best of you might tempt you to still hold on to your stocks. You may do this with the hope that the price will shoot up even more. This is possible, but how disappointing would it be if you held your stocks only for the price to plummet again? Stock price increases are usually the result of speculation and are very ephemeral. Consider selling your stock and then buying it back when the price drops if you believe in the firm. Number 5, if your stock was a mistake. There is no such thing as a perfect investor. You will make blunders during your investing career, but one thing you must never do is be too hard on yourself. If you're too hard on yourself, you will never invest again. And even if you do, you won't be as confident. Always remember that investing is, at most, a form of speculation with no exact science. Mistakes will be viewed as opportunities to learn and improve. If you've done your homework and discovered that you bought stock by accident, then sell. Even if it means losing money, it's best to sell your investment and put your money somewhere else as soon as you realize your error. Try and keep the cost of your error to a minimum. Holding on to poor performance is a sign of stubbornness. Number 5, when a company is declared bankrupt. Although it may seem self-evident, bankruptcies are a clear indication that it's time to sell. A corporation that declares bankruptcy loses all of its value to its stockholders. Your stock will almost certainly lose a large amount of value, but it's better to sell it for something than to keep something useless. Do your research, keep track of the company's performance, and jump out before the investment vehicle crushes even before others hear about the imminent bankruptcy. Number 4, when a company is acquired for a higher premium. It's essential to act quickly when a corporation announces a merger or acquisition. When a company is purchased out for a high price, stock price usually rises. It's a fantastic moment to cash in on your investments and lock in your gains. According to experts, the average takeover premium can be anywhere between 20 and 40%. This means that you'll be getting the higher pricing and getting out of the storm. Mergers and acquisitions can be beneficial to a company's future, but they can also be disastrous. If the deal falls through or if the abrupt change in structure causes performance to suffer, sometimes they take so long to complete. Number 3, when an opportunity presents itself. No successful investor got to that level without being an opportunist. Opportunity cost refers to the profits you would forgo if you choose one option over another, according to Investopedia. Trading stocks is fundamentally a game of calculating opportunity cost. You want to save money by choosing the choice that will provide you the most advantage. Before purchasing a stock, you should spend time researching and comparing many possibilities before deciding on the best one. However, this does not guarantee that your choice will always be the best performer. Your first stock may begin to underperform, or there may be a poor performing one that catches you off guard and begins to perform well. Number 2, when business fundamentals decline. When you hold shares in a firm, the most important thing you need to do is carefully check on its financial performance. This way, you're among the first to know the company's deterioration. Some of the aspects you need to look at include sales volume, profit margins, and cash flow. Experienced investors who demand complete control may find themselves delving into the financial accounts of companies on their own. Aside from financial indicators, you want to keep an eye on your company's overall public relations. Anything that could tarnish the company's brand, such as fraud or high-profile leaders' general behavior could cause your stocks to plummet. Even the smallest hint of things not going as planned should encourage you to sell. And of course, number 1, hitting your price target. The best thing to do when you reach your target is to leave. It's said that you should stop only when you're ahead. Show me one successful investor who is emotional. I don't think you managed to mention one. Setting a price target is one of the most beneficial things you can do for yourself, and it's the greatest time to sell your stock no matter what once you've reached that aim. You'll be able to lock in a substantial profit this way. Factors to consider. Keeping in mind all the things that we've talked about, there are 3 other things you need to keep in mind when selling your stock. Limit losses. You should always limit your losses to range between 7 to at most 8%. This is because even the finest stocks will occasionally break out, only to fall back to a level just below their ideal buy price. If your stock falls by more than 8%, something definitely went wrong somewhere. You either messed up at entry when you bought, or the firm's industry is performing poorly. Sometimes it could be both. When to take profits. Seeing the value of your stock rise is one of the most satisfying experiences. But how long should you wait before withdrawing your funds? Taking most profits at 20 to 25% during a robust market is a good idea. Hold for 8 weeks. If a stock has the ability to quickly leap about 20% from a solid basis, it may have what it takes to become a great market winner. The 8-week hold rule can help you spot these stocks. Hold your stocks for at least 8 weeks. If it has gained 20% in less than 3 weeks, it's critical to understand when to sell. Proper marketing minimizes the risk of 2 negative outcomes. First and foremost, proper selling aids in the preservation of gains. In the second case, proper selling decreases the chance of suffering significant losses. And that will be it for today's video. I hope you liked it. If you did, make sure to hit that like button and subscribe to the channel so that you never miss any amazing videos from us. As always, share your thoughts in the comments section and I'll see you on the next video. Thank you for watching.